Hash how companies turn losses into billion-dollar valuations. In 2019, Uber went public. It was one of the most anticipated IPOs in history. Millions of people used the app. The brand was globally recognized. The company had fundamentally changed how cities move. It had also lost $8.5 billion that year alone. Not revenue, not investment. Losses, $8.5 billion gone. And yet, on the day it went public, Uber was valued at $82 billion. Nobody blinked. That's not a glitch in the system. That's the system working exactly as designed. And once you understand how it works, you'll never look at a headline valuation the same way again. Let's start with a question that sounds simple but isn't. What is a company actually worth? If you ask an accountant, they'll talk about assets minus liabilities. Buildings, inventory, cash on hand, debt, concrete things, numbers you can verify. But if you ask a venture capitalist, or a growth investor, or most of the people who set prices in modern markets, they'll give you a completely different answer. A company is worth whatever someone believes it will be worth in the future. That single idea, the primacy of future belief over present reality, is the engine behind almost every billion-dollar loss-making company you've ever heard of. Amazon, Netflix, Tesla, Spotify. WeWork almost. The logic is the same even when the outcomes aren't. Here's how the story usually begins. A startup finds a market that's either broken, inefficient, or completely untapped. It builds a product, gets early users, shows that people want the thing. And then it faces a decision every high-growth company eventually faces. Do you grow slowly and sustainably, or do you pour gasoline on it and grow as fast as physics allows? Almost every venture-backed company chooses gasoline. Why? Because in winner-take-all markets, and most tech markets behave like winner-take-all markets, being second is nearly the same as being last. If you own the platform, you own the network. And networks compound. The more people use Uber, the more drivers join. The more drivers join, the better the service. The better the service, the more people use it. A competitor starting from zero has to fight physics. So the calculus becomes, spend now to lock in dominance. Worry about profit later. This isn't reckless, it's deliberate. It has a name. It's called blitzscaling, a term popularized by LinkedIn co-founder Reid Hoffman. The idea is that speed of scale is more valuable than efficiency. Get big fast, establish the moat, then figure out the economics. The losses in this framework aren't failures. They're asterisk investments in a future monopoly. Now here's where it gets interesting. Investors fund this strategy. They give a company hundreds of millions of dollars to grow at any cost. The company burns through it on subsidized rides, free deliveries, discounted subscriptions, essentially paying customers to use the product and build the habit. Each funding round comes with a valuation attached, not based on earnings, not based on revenue always, based on projected market size, growth rate, and the story the founders can tell about where this ends up. Round A, $10 million, $50 million valuation. Round B, $50 million, $300 million valuation. Round C, $200 million, $2 billion valuation. Each round, new investors buy in at a higher price. The earlier investors hold paper that's now worth more on paper. Nobody has made real money yet. The company still isn't profitable. But the asterisk narrative asterisk of inevitable dominance keeps pulling capital in. This is the part that looks from the outside like magic or madness, depending on the day. Here's the uncomfortable math beneath it. Valuation in these rounds is almost entirely a negotiation. There's no formula that spits out the number. Investors look at comparable companies, growth trajectories, total addressable market, and then they guess, informed by experience and anchored by optimism. When a venture firm says a company is worth $2 billion, They don't mean it has $2 billion in value today. They mean, if this works out the way we think it might, $2 billion is a reasonable price to pay for our share of that future. It's a bet, a structured professional bet, but a bet. And here's the kicker: the valuation number that gets reported in the news, the one that makes headlines, the one people use to decide whether a company is impressive or not. That number is based on the asterisk last round of funding. It takes the price the most recent investors paid per share and multiplies it across all shares outstanding. Which means the headline valuation is essentially the price the last people in agreed to pay times everything. That's it. That's the whole calculation. If a single investor paid $100 million for 1% of a company, that company is now a $10 billion company. In the press release, on the news, on the Wikipedia page. Whether or not anyone else would ever pay that price. Now contrast that with reality. WeWork hit a paper valuation of $47 billion in 2019, based on a single SoftBank investment made at that implied price. SoftBank had enormous incentives to show its portfolio growing. Its own investors expected it. WeWork's founder, Adam Neumann, was a masterful storyteller who convinced serious people that renting office space was somehow a tech company. When WeWork tried to IPO and actually opened its books to public scrutiny, analysts found a company losing $219,000 every hour. The valuation collapsed to below $5 billion in weeks. The IPO was pulled. Neumann walked away with close to $700 million in various exit packages. The company still exists, still loses money, still operates. That story is extreme. But the underlying mechanics are not unusual. They're the same mechanics, just pushed past the breaking point. For every WeWork, there's an Amazon. Amazon lost money for years. Investors kept funding it. Jeff Bezos kept telling a story about the future of commerce, about infrastructure, about becoming the backbone of the internet. Most people thought he was delusional. He wasn't. Amazon